The next thing that we need to talk about is education savings accounts and qualified tuition programs. These are very similar things, but slightly different. And really, I haven't seen an education savings account for quite a while, at least not a new one. So that's almost obsolete. The more common type of way to save up for college is a qualified tuition program. So we will skip ahead to the qualified tuition program. These are more popular now because they are easier to manage. There's fewer contribution limits. And what a qualified tuition program is that you can save money for future tuition expenses. There are basically two types of qualified tuition plans. One is where you put money into some sort of savings account or brokerage account. And similar to a Roth IRA, it grows tax-free. You don't get an immediate deduction for putting money into a qualified tuition program or 529 plan. But it does grow tax-free. And if you follow the rules and spend it only on qualified education expenses, then you don't pay taxes on any of the earnings or growth either. So very similar to a Roth IRA in this case. That's a savings-based plan. A different type of qualified tuition program or 529 plan is a prepaid tuition plan. So you can actually pay for your 2-year-old's college tuition right now and pay 2024 tuition rates. And then when they're ready to go to college in 2040 and tuition has gone way up, you've already paid for it and it grows tax-free. I'm not sure exactly what the rules are on transferring it from one college to another. So if you're paying University of Alaska tuition, I'm not sure how that works for if they end up getting into MIT or something like that. But it still grows tax-free and grows based on the increase in tuition instead of the increase in the stock market or however you're investing it. One interesting thing about qualified tuition plans is you can also use them before college. You can pay for private school and up to $10,000 in tuition per year. You can also use them to pay for student loans even after they get out of college, and I think that's also $10,000 per year.
Tuition for a private school?
Tuition for a private school even before college, that's $10,000 per year. Let me double check that. Yeah, $10,000 per year. And you can also use a qualified tuition program or 529 plan to pay student loans off, and it still counts. And that's 10,000. It turns out 10,000 total for the student's lifetime. Now, we didn't really talk about Coverdell ESAs, but there is an annual contribution limit to the ESA. One of the reasons that qualified tuition programs are now much more popular than ESAs is because there's no annual contribution limit at all. In fact, you're allowed to keep contributing to a qualified tuition program as long as it's reasonably equal or less to what an entire 4-year degree would cost. So I think, and then this is based on some research I did last year, you can contribute to an Alaska 529 plan up to like $250,000. And again, it grows tax-free. And as long as you use it for education expenses, you don't pay tax on any of the earnings.
Which high school qualified for that?
No, it has to be elementary or secondary. So any K through 12, not preschool. Now, whenever you take money out of a qualified tuition program, let's see if we have an example. No. When you take money out of a qualified tuition program or Coverdell ESA, you get a Form 1099-Q. Remember, the 1099 is you're getting money. The Q in this case stands for Qualified Education Programs. And it'll have an amount in gross distribution and earnings. Now, if you've used all of the distribution to pay for education expenses, you can basically ignore the 1099-Q. The IRS may come back and ask you to show how you spent that money, but as long as you have proof that you spent it on education expenses, then none of it's taxable income. If you spent it on some education expenses and some not education expenses, well, let's say you spent it on not education expenses. So let's say you're going through a downturn economically in your life, and you say, well, I know I saved this money for my kids' college, but I need the money. So you take it out. You take some money out of your kids' qualified tuition program, which you can do. You're still the account owner. The kid is the beneficiary, but you're still the account owner. You can take that money out. You're going to pay tax on earnings plus a 10% penalty on the earnings. And it's always considered pro rata. So if I put $10,000 into a qualified tuition program and next year it's worth $11,000, and then I take $1,000 out, it's always going to be pro rata, which means in proportion. So that means $900 is going to be part of my original contribution, and about $100 is going to be my earnings, and I'll pay tax on the $100. It's also possible that you may have used part of it for education and part of it for other purposes, and then you'll again multiply it by a proportion, figure out how much is taxable. So maybe I took $2,000 out, and 200 of that 2,000 was earnings, and spent 1,000 on education expenses, and spent 1,000 on myself. So out of the $200 in earnings, then $100 is taxable and $100 is not taxable. It's pretty complicated, but it is more relevant when we talk about, skip ahead to the section on scholarships and fellowships. Now, let's say you saved up for your kids' college and you've got $50,000 in their qualified tuition program, enough to pay for most of their college. But your kid turns out to be a genius and they get a scholarship for the entire 4 years. So there's no expenses at all for them. What are you going to do with that $50,000? Well, you could still take it out and you'll pay tax on the earnings, but with no 10% penalty. So you can take out money from your qualified tuition program even if the expenses are already paid through some other means. You can also take this money out of, the second reason you might encounter this is if you take money out of your qualified tuition program and you don't count any of the earnings as taxable, you have to reduce the expenses for the American Opportunity Credit and Lifetime Learning Credit. So if your kid has $5,000 in tuition, you take $5,000 out of your qualified tuition program, well, by default, that would not be taxable. None of the earnings would be taxable or anything. But then $0 of that would be considered out-of-pocket expenses, and you'd get no American Opportunity Credit. But maybe you say, well, I want some of that American Opportunity Credit. So you could treat 4,000 of that as a non-qualified distribution, even though you are paying for tuition with it, and still get $4,000 worth of expenses for purposes of the American Opportunity Credit. And then, which you actually took 5,000 out, which means 80% of your draw is now considered a non-qualified distribution, which means 80% of your earnings you'll treat as taxable income. And the earnings is going to be a small part of the total amount you drew out. So maybe you end up counting, I took 5,000 out, maybe 1,000 of that was earnings, and I want to treat 4,000 of that as a non-qualified distribution in order to get that American Opportunity Credit. So 4/5, 4,000 out of 5,000 of the $1,000 earnings, 80% of that is $800. So I'm going to pay tax on $800 income, which at a 12% tax rate, I'm paying $96 extra in taxes to get a $2,500 credit. Seems like a good trade-off to me. If you do that, you don't have to pay the extra 10% penalty. So it's just $96 in taxes and not 96 plus extra 10% of another 80. What else can you do if your kid, well, maybe you saved up more than your kid actually needed for college, or maybe they decided not to go to college and you've got this money lying around. What can you do with that money? Well, you could just take it out, cash it out, and take the extra 10% penalty on it, or you could roll it over to a new beneficiary. So what? Your son didn't go to college. Well, maybe your daughter wants to go to college. So you can take his name off and put her name on. Or maybe you ran out of kids, but now you have grandkids. So you can take one of their names off and put one of your grandkids' names on. Or you have nieces or nephews. You can roll over a 529 plan from one beneficiary to another as long as they're closely enough related. Unfortunately, it's not in the book, and I believe that is first cousin or closer.
First cousin.
Yeah, I believe it's first cousin or closer from the previous beneficiary. So that means if you're saving up for one of your grandkids and they don't want to go to school, you could change the beneficiary to a different one of your grandkids, because that would be a first cousin.